What if I told you that intentionally buying stocks that have already gone up drastically is actually one of the safest ways to build long-term wealth? Most retail investors spend hours trying to catch undervalued stocks at the absolute bottom, only to watch them drop even lower. But our latest data-driven backtest reveals that ignoring the bargain bin entirely and focusing strictly on top-performing assets yielded a staggering 34.83% annualized return over the last 5 years. But that's not the surprising part. What's truly shocking is how it managed to do this while heavily capping downside risk during market crashes. So let's test it. First of all, let us understand what exactly is momentum investing. In simple terms, it is the financial equivalent of Newton's first law of motion. An asset in motion tends to stay in motion until acted upon by an outside force. In the stock market, this means that companies that have performed exceptionally well over the past 6 to 12 months have a highly significant tendency to continue outperforming over the near term. Traditional investing tells you to buy low and sell high. Momentum investing flips the script. We buy high and sell even higher.
This isn't a speculative theory. Momentum is a deeply researched market anomaly backed by decades of global academic data. It works because of institutional buying behavior. When a company posts blockbuster earnings, large mutual funds and institutions cannot buy all their shares in a single afternoon. They accumulate slowly over weeks and months, creating a persistent structural upward floor for the stock price. A quantitative strategy simply uses mathematical rules to hitch a ride on those massive institutional waves.
Let's build our systematic framework from scratch. First, our hunting ground. We use the Nifty Largemidcap 250 universe. This provides a highly liquid blend of established giants and high-growth midcaps, completely eliminating the risk of illiquid penny stock manipulation. Next, we apply our first line of defense: absolute momentum. For a stock to even be considered, its current close must be above its 100-day exponential moving average. Additionally, the 50 EMA must be above the 100 EMA, and the 100 EMA must be above the 200 EMA. This triple filter guarantees the stock is in a confirmed, healthy long-term uptrend. But here is the critical master switch that protects our capital. The broader Nifty index must also be trading above its own 100-day EMA. If the macro market is crumbling, the strategy automatically stops buying and moves to cash. Finally, we apply relative momentum. Out of all the stocks that pass our trend checks, we rank them using a price rate of change metric called change percent. We buy the top 15 fastest moving stocks, equally weighted, and rebalance the portfolio precisely once a month. Now, let's run the historical backtest on the continuous platform over the last 5 years and look at the performance. A quick disclaimer, before we see the backtest result, this backtest uses the current index constituents for historical testing, so it does include survivorship bias. Historical point-in-time index constituent data are not yet available in Quantinews, but we are working on adding them and will update you once it's ready. Now, let's see the backtest result. Our starting capital of 5 lakhs rupees compounded into a final wealth of 22.28 lakhs. That represents an annualized return, or CAGR, of 34.83%. At this rate, your investment capital doubles roughly every 2 years. But look at the next metric, because this is where most investors get it wrong. They assume high returns require taking catastrophic risks. The maximum drawdown, which measures the absolute largest peak to trough drop the portfolio experienced during these 5 years, was just negative 12.13%. For an aggressive, all-equity portfolio, keeping your worst-case peak historical drop to just 12% is remarkably rare. Out of 44 total months, 29 were winning months, and only 15 were losing months. Why did this mathematical approach perform so cleanly? It comes down to risk truncation. When a major market correction strikes, stocks begin breaking below their moving averages, and the Nifty index violates its 100 EMA. Instead of holding on and hoping for a recovery, our quantitative rules force the system to liquidate deteriorating positions and step aside into cash. By eliminating the toxic downside, compounding works uninhibited on the way back up.
If you want to integrate this data-driven mindset into your wealth journey, remember these 3 core rules. First, price is the ultimate reality. News and expert opinions are noise. price trends tell you exactly where institutional money is moving. Second, you must have an automated exit plan. This system maintained a tiny 12% drawdown because it cut losses without hesitation, hope, or fear. Third, systematic consistency beats sporadic genius. You don't need to predict the next multi-bagger. You just need a proven edge applied flawlessly month after month. If you want to build, modify, and execute identical algorithmic backtests using your own parameters, you can explore these exact frameworks on the Continuous platform. The link to get started is in the description below. Also, if you want to get this complete backtest result with stock-wise entry and exit for last 5 years, then subscribe to our Substack newsletter. Every week, we share the full backtest results PDF. If you are serious about systematic wealth creation, that is where all actions happen. Thanks for watching, and we'll see you in the next video.